On Tuesday morning, something happened that changed the entire Australian property market calculation for 2026. Inflation spiked when everyone was expecting it to fall, and in response, 53 banks immediately repriced their mortgages. This is the story nobody's talking about, but everybody needs to understand. By the end of this video, you'll understand exactly why the RBA's decision on February 3rd is now more certain than we thought, and why the cost of your mortgage could jump by $90 to $150 every single month before the end of this quarter. But first, let's talk about what just happened, because the markets moved faster than most analysts predicted. Let's start with the data. On Tuesday, the Australian Bureau of Statistics released December quarter inflation figures, and they landed with a thud. Headline inflation came in at 3.8% year on year for December. That's up from 3.4% in November. Most economists expected inflation to moderate going into 2026, a slow decline back towards the RBA's 2 to 3% target. Instead, it actually went backwards. The quarterly trimmed mean, which is the RBA's preferred inflation measure, the one they actually care about for property decisions, came in at 3.4% annually for the quarter. That's also up. And here's the important bit. The quarterly trimmed mean was 0.9%, which exceeded economists' forecasts. So what does this mean in plain English? Inflation is a lot stickier than central banks wanted to believe it was. It's not cooperating with the script. This is the data that landed 2 days before the RBA's board meeting on February 3rd, 2 days. So the board members have this fresh inflation reports in their hands. They're looking at services inflation staying elevated, rents, insurance, haircuts, the sticky stuff. They're seeing inflation re-accelerate instead of easing. That was supposed to be the key reason the RBA would hold rates steady. We'll wait for more evidence that inflation's coming back to targets. That's what they said. Now, that evidence isn't there. It's actually moving the opposite direction. So here's the calculation facing the RBA board. Do we hold and wait, or do we hike and signal that we're taking inflation seriously? Because right now, the market and the banks are already making that decision for them. So here's what gets interesting. Over the past 2 weeks, January 15th to January 21st, 53 Australian lenders have repriced their home loan rates. All 4 major banks moved, and the movements weren't small. Commonwealth Bank went the hardest. On January 15th, they hiked their 3-year fixed rate by 70 basis points. That's a 0.7%. For a typical borrower with $500,000 mortgage, that translates to more than $200 extra per month on that rate. Their 2-year fixed rate jumps by 35 basis points to 5.94%. Macquarie lifted rates by 25 basis points across all fixed terms. The second hike in 6 weeks, by the way. NAB and Westpac both moved as well. But here's what I want you to understand. This isn't the RBA moving. This is the banks moving preemptively. They're positioning for what they think the RBA is about to do on February 3rd. When banks start repricing en masse like this, it's not a guess anymore. It's a conviction play. These are major institutions with billions of dollars on the line, and they're saying, we expect the RBA to move, so we're moving first to protect our margin. Here's the broader damage. According to CanStar data, only 12 lenders in the entire country are now offering rates under 5%. 3 months ago, there were over 40. That's a dramatic narrowing. And get this, 2 lenders have already started raising the variable rates. Not fixed rates, variable rates. That's the canary in the coal mine. What does this mean for borrowers? So according to CanStar's stress test, a 0.25% cash rate increase equals to about $90 per month on a $600,000 mortgage over 25 years. A $750,000 mortgage jumps $112 per month, and a $1 million mortgage jumps $150 per month. Now multiply that across Australian households. That's not small money. Here's where the Economist community stands. And this week's inflation data just clarified the fault line. Commonwealth Bank and NAB both predict a 25 basis point rate hike in February. CBA's head of economics, Belinda Allen, made a firm call. The economy has picked up more momentum than expected, and that strength is keeping inflation from easing. A small rate increase in February would guide inflation back towards the RBA's target. That's not could happen, that's will happen in CBA's view. And NAB goes further. They're forecasting hikes in both February and May. On the other side, Westpac and ANZ are holding their no change calls. Westpac's reasoning is that earlier rate cuts are still flowing through the economy. Household spending remains fragile and more data will be prudent. The Australian Financial Review surveyed 38 economists. 7 of them, including CBA and NAB, predict a hike in February. The rest are split between hold and see and wait until May. But here's the signal nobody's talking about. Before Tuesday's inflation data, markets were pricing only a 60% probability of a February hike. That number is likely much higher now. Why? Because inflation coming in hotter than forecasts removes one of the main arguments for patience. The RBA's preferred measure, which is the trimmed mean CPI, is at 3.4% annually for the quarter. And they want it at 2 to 3%. That gap's not closing fast enough on its own. KPMG released new housing forecasts this week. They give us a clear picture on what's actually driving the markets, which is government policy. The chief economist, Dr. Brendan Ryan, made an explicit statement, and I quote, "The strength of the housing market in the second half of 2025 surprised forecasters, with government policy playing a bigger role in accelerating demand than anticipated." He's specifically talking about the first home guarantee expansion, the removal of income gaps, the removal of annual place limits. That policy turbocharged demand at the affordable level. And here's the proof. More than 3/4 of real estate agents reported increased activity following the scheme's expansion. That's most agents in the country seeing more first home buyers walking through doors. But there's a catch, and it's a big one. Sharp price growth is already outpacing the scheme's price caps. Less than half of Australian suburbs now have median values below the price caps. That means the scheme was supposed to help first home buyers is becoming irrelevant as prices rise. Think about this. You expand a scheme to help people to get into the market. More people try, competition increases, prices also increase. Now fewer people qualify for the scheme. The policy is eating itself. This is what demand surge without supply looks like. It's not a sustainable pattern, it's a pressure cooker. Meanwhile, the Housing Industry Association issued a stark warning this week. They called on the government to rule out any further changes to negative gearing and capital gains tax. Why? Because investors build more than 40% of the new homes in Australia. If you discourage investor participation, you don't free up housing, you stop it being built. HIA chief Tim Reardon did the maths. Around $570,000 in taxes, fees, and charges are now embedded in the cost of a typical new home and land package. If you add more taxes on top of that, you increase capital gains tax or change negative gearing, you're essentially pricing new housing out of the market. Reardon's quote is worth hearing directly, right? The goal should be a minimum 3% rental vacancy rate, and we only get there by reducing the upfront tax burden on new housing, not increasing it. So we have a situation where demand is being turbocharged by government policy, supply is being constrained by tax policy, and now interest rates are about to tighten, which will reduce borrowing capacity. That's not a market in equilibrium. That is a three-way squeeze right there. Let's be clear about what actually hasn't changed, because sometimes understanding stability is as important as understanding movement. First, auction clearance rates. We got New South Wales data through January 18th. The SQM report showed 42.1% clearance in Sydney for that week. That's down from 80% territory we were seeing in November and December. But we need another week of data to call it a trend. It's just too early. Second, building approvals. November data showed 18,406 dwelling approvals. No new January data has been released yet, so we won't see that until early February. So supply signals haven't shifted. And third, rental vacancy rates. SQM Research hasn't released a new weekly vacuum report this week. Last we saw was December at 1.4 to 1.6% nationally. That's still critical levels, but no new movements to report on. Now, why does this matter? Because when the RBA makes its decision on February 3rd, The property market doesn't react to old data. It reacts to forward expectations. And the forward expectations just changed dramatically. Banks are hiking its rates. Inflation accelerated instead of eased. The RBA has fresher, stickier inflation data than they had a month ago. The board's calculation is different today than it was a week ago. But the market's structural forces, supply shortage, demand surge, inventory crunch, those haven't changed. They're still there. They're still the backdrop for everything else. Everything converges on February 3rd. That's Tuesday. That's when the RBA's board announces its decision. Here's what matters. They need to decide whether the December inflation data justifies a rate hike. Will they take action or will they wait? And if they wait, what's their tone? Are they signaling more hikes to come? Or are they sitting on the sidelines? The tone matters as much as the action. A hold with hawkish language could be worse for the market than a 25 basis points hike with patient language. Once the RBA moves or doesn't move, here's what happens. Lenders will reprice again. Mortgage brokers will immediately adjust their advice. Buyers on the fence will make decisions. Investors will recalculate yield assumptions. And the market's momentum will either accelerate or stall, depending on what the RBA says. For property investors specifically, watch the language around inflation and growth. If the board signals they expect inflation to ease later in 2026, that's dovish. If they signal persistent upside risks to inflation, that's hawkish. That language shift will determine whether we see one hike or multiple hikes this year. Right now, if you're a property investor, here's what's actually happening. First, the market's demand surge is policy-driven, not organic. That matters because policies can change. If the government stops expanding first home buyer schemes, demand softens. That's not a year away, that's a policy decision away. Second, your borrowing costs are about to move. Banks have already repriced. The RBA's decision will ripple through the market within days. Stress test your portfolio against $90 to $150 per month in additional costs. That's real money on a portfolio of properties. Third, supply is constrained by tax policy. That's actually good news for existing property holders. Less supply supports prices, but it's bad news for renters and policymakers. If the government decides to increase property taxes to solve the rental crisis, that could create a vicious cycle. Fewer new homes, tighter supply, higher rents, more political pressure for tax increases. And fourth, the first home buyer scheme is working, but it's eating itself. As prices rise faster than the scheme's price caps can keep up, fewer people actually qualify. That's creating a false sense of affordability expansion. The supply problem isn't being solved, it's being masked by policy. So here's the takeaway. The Australian property market in 2026 isn't being driven by fundamental supply and demand. It's being driven by policy levers and interest rate expectations. Those can both move very quickly. That's not an invitation to panic though. It's an invitation to be prepared. Know your numbers, understand your serviceability. Don't assume policy settings stay the same. And don't assume that demand surge continues if interest rates move. That's what's changed this week. Inflation reaccelerated. Banks reprice mortgages. First home buyer scheme caps are eroding. The RBA's decision just got clearer in some ways and murkier in others. February 3rd will be the hinge point. Everything else follows from that decision. If you found this breakdown useful, if you're thinking about your property strategy differently now, I'd love to hear your take in the comments. What's your move after February 3rd? Are you locking in fixed rates, holding tight? I want to know. Subscribe to this channel so you don't miss next week's update. That's when we'll see how the RBA actually responded and what the market's move means for real. If these weekly updates help you stay ahead of market moves, if you want to understand what's actually driving the property market instead of reacting to headlines, hit like and subscribe. The property market moves fast. You need data that moves faster. And if you're trying to decide whether to lock rates now or wait for the RBA decision, or if you need to stress test your property strategy against rising interest rates, that's exactly what InvestDoor is built for. We've got calculators that show how rate changes affect your serviceability, your yield, or your portfolio strategy. Come join us. There's a link in the description. Book a call with our team if you want to talk through your specific situation. Let's make sure you're prepared for what February 3rd brings, not caught off guard. Thank you for watching.